Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, July 25th, and then we'll see how things look for Wednesday, July 26th. We had another up day. That just kind of seems like a broken record right now. We're still looking more overbought. The market still looks positive overall, so we have to default to that. There's some big things coming up. We have reaction to earnings reports. We have the Fed making their announcement. We'll have to see, is that going to shift the climate? Are they going to say some things at the press conference that the market isn't going to like? We don't know how that's all going to unfold, but we'll be watching, we'll be regrouping, we'll be looking at things, we'll be evaluating things, and then try to reach a conclusion. Let's go back and talk about what happened. At the open, we had a higher open. We really didn't have a gap. We just moved higher after the market opened. Prices went above R1 at 45.65. As the day went on, prices rose up above R2 at 45.75. Then we fell back a little bit and closed slightly above R1. We were up 0.28% on below average volume. You still have a lot of folks that are kind of apprehensive. The technicals are still positive. We're still overbought. That part hasn't really changed for right now. We are seeing a few little bits of weakness that are coming into the market, but we'll always see that. The market is never black and white. There's positive things, there's negative things. We just have to weigh the difference between the two. I'll show those things as I go through the charts. Mainly it's about inflation and interest rates, and that's what it's all going to be about on Wednesday. What are some comments that we can make? Both the S&P and the Dow hit another 52-week high when they got to their best levels of the day. The Dow has now had 12 straight winning sessions. Mega cap stocks did outperform again. And earnings were taken mostly as positive, the ones that have been released. And then another thing that kind of has to do more with all of the economy is the Teamsters and UPS reached a 5-year tentative collective bargaining agreement, supposedly to avoid a strike. And is there some weakness developing? I'll go through the charts. I'll try to point those things out as I see them. We're still dealing with this positive scenario, but again, this can change at any time. Especially with the Fed making their announcement and giving the press conference today. That could switch things or reinforce what's already happening. The idea that we're going to have a soft landing without going into a recession, that the Fed is almost done raising interest rates, and that earnings growth looking out into the future still look good. On a short-term basis, we do have a lot of extreme positive readings. The moving average study, the Williams percent R, the CCI based on 20 periods, the standard deviations chart, the stochastics, and the RSI 9. Intermediate term basis, we also have a lot of extreme readings. The rate of change going back 50 periods, the PMO studies, our oscillators, mainly the NASDAQ 100. That's what we're worried about, but we're starting to see some of our oscillators begin to roll over negative. The Sean Trend Meter and the BPI based on the S&P 500 as well as the NASDAQ 100, and then finally the RSI based on 14 periods. Long term, we still have the 150 and 200-day moving averages that are kind of looking a little extreme. The dollar was up and interest rates were also up. The yield curves still remain inverted. Sentiment is still extreme positive. It ticked down to 81. That's still a high level where it had been at 82. Our trend is positive and the green line is now turning back up, so it's advancing. The ADX is above its moving average. Both are above 20. Both are getting close to 40. So they're still looking rather extreme. We can take that two ways. Number one, that we're getting extreme positive and due for a pullback, or that that's just showing good solid momentum. Our bias and our momentum continue to be positive. The economic reports that came out, we had the FHFA Housing Price Index up 0.7%, the same as last time. The S&P Case-Shiller Home Price Index was down 1.7%, less than the down 1.9% they had expected, the same as what we saw last time being down 1.7%. Consumer confidence actually went up a little bit. It was at 117. They expected 111.5. Last time it was at 110.1. If you go back a year ago, we were at 95.3. So on a year-over-year basis, we are showing some improvement. Here are some charts. Here's the FHFA Housing Price Index showing how we dipped a little bit, but now we're starting to go back up with housing prices. Here's the month-over-month look where we're above zero, so we are showing some improvement there after really falling back down. S&P Case-Shiller Home Price Index where after dipping back down, it's now starting to go back up. And here's a year-over-year change showing how we're still declining when we compare this year with a year ago. Consumer confidence also showing some improvement. The blue line in the middle, that's the total, and that's showing some improvement there. The expectations are leveling out, but also showing a bit of improvement. And the present, how they feel right now, it's also showing that there is some improvement. Looking at some IsabelNet.com blog charts. The first one, the S&P trades at 20 times its PE when you take it all together. But if you take out the big boys, it's at 17 times earnings. So here we have the mega cap stocks, where together they're trading at 32 times earnings. That's quite expensive. But when you take those out, we're down at 17, where together the S&P is at about 20. Depends on how you measure this. I go through this every week in the intermarket analysis chart to know if we're expensive, inexpensive, or fairly priced. And we look at earnings going backwards as well as what's projected to go forward. Consolidated equity positioning. Folks are continuing to get more into stocks. Also, futures positions are also coming down just a little bit, but they're still pretty high overall. Short interest is also pretty low and it's dropping off. I explain this every time we see this chart. These are folks that have to sell to get into the S&P 500 with the hope that it will go down. When they exit that position, they have to buy. Well, it's nice to have a good level of these short interest folks in there, because if the market really starts to go up, they have to buy to get out, and that pushes the market even higher, and that's what we call a short cover rally or a short squeeze. It's not all that high right now, but it is going up a little bit from where it had been. Are you more likely to increase or decrease your exposure to stocks? It's jumped back up to 33% now, where it had fallen below that. We're also looking overbought. With this composite index, we're up at 90 right now. Again, two ways to look at this: that we're due for a pullback, or that this is suggesting good solid momentum. The NASDAQ 100 futures positioning, that's kind of the place to be right now. We're seeing a real growth of folks getting into those instruments. And then Japan, still seeing a lot of money going into their market, as well as the junk bonds, where a lot of money continues to come out of tips. GDP for right now, we're going to get a read on that later this week, where Goldman Sachs still has this at being at positive GDP. The consensus still thinks that we're going to go down in the fourth quarter of 2023. Then duration and magnitude of a non-recessionary decline. This chart goes all the way back to 1946. This is the number of days that we went down without being in a recession. And what was the magnitude of that decline? We saw that back in 2022 being down 25.4%. The average is 22.7%, with the median being 20.6%. And then once it bottomed, how far up did it go from there? Just some kind of interesting statistics. Keeping an eye on the Fed, because we're watching that right now. There's a 98.9% chance that they're going to raise rates 25 basis points to 5.25 to 5.5 at the meeting. If they don't do that, that's really going to catch the market off guard, because that's what they're pretty much expecting. Here's how it's changed. It hasn't done all that much in the way of changing over the last few days. The dark blue area is where we're at right now. This was yesterday, last week, and then a month ago. So it has risen from where it was a month ago, but it stayed pretty much the same for the last month. Looking at our charts and analysis, where we did have a higher open, we made it finally up to R1. Then we broke above R1, got all the way up to R2. We're able to go slightly above that before we saw some selling later in the day, and we closed just a little bit above R1. Here's the intraday chart, looking fairly positive, where we were flat in the initial overnight session. In the pre-market session, that's where we started to see some improvement, but then it went negative for a while. We got that back during the cash session, and now we're falling down a little bit as earnings are being reported in the initial overnight session. Growth versus value. Growth is still underperforming overall, and they were both down at the end, but they did have a pretty good day, both together. Here's the closing basis, where growth outperformed value for the large caps, the mid caps, as well as the small caps. So when we look at S&P growth versus value, we were above the dashed line. That's positive, showing a little bit of improvement there. Sentiment, still not showing that there's an awful lot of fear. Our Ulster Index continues to drop lower. The VIX is pretty much chopping sideways with the line chart and increased just a little bit when you look at the whole bar on the bar chart. Volatility is also starting to drop below the moving average, both with the bar chart and the line chart. This could probably pick up after the Fed makes their announcement. We're also keeping an eye on the VIX to S&P 500 correlation after we spiked up and we've been coming back down. That is one of the areas we've been watching as justification for maybe having a short-term pullback. Doesn't seem to be really having an effect right now. Also looking at the equity put-call ratio over 5 periods, where we're wondering, have we bottomed and are we going to start to go back up? Now that could be negative for the market. Typically the equity put-call ratio goes down when the market's going up. So we want to keep an eye on this. This is another potential thing that we're watching, suggesting the market is due for some kind of a pullback. Here's a longer term version of that same chart where we're down below this 0.55 level. Are we going to bounce back up or will we continue to go lower? Then the equity put-call ratio longer term, it is declining and that is positive. The MOVE index actually ticked up a little bit. Bonds had kind of a difficult day where stocks had a pretty good day. We're seeing a drop-off in the strong correlation between the two. The one fear gauge that we look at continues to show that we're declining, and this other fear gauge is also showing a decline in fear. We saw another little bit of a tick down in our risk-on, risk-off ratio, but overall it still continues to climb. Our advanced decline line study showing improvement here based on price as well as volume, even though we were pretty much flat with volume. We're still seeing a healthy dose of new highs. Our 5 period is continuing to go up, and our 10 period is leveling off a little bit as some of these other high readings start to catch up with the calculation. The advanced decline ratio above 0 and advancing, that's positive. This is a little bit concerning, but we saw a little bit of an improvement here. We have dropped below the moving average with the accumulation distribution, but it's starting to go back up. We want to see this go back above the red line because this tries to measure what is the smart money doing. We saw a little bit of a tick down with our cumulative NYSE advanced decline line, but it's still been going up lately. And the other advanced decline line is also showing improvement. This advanced decline line also is starting to break out above previous highs. So that is suggesting that things are positive. With the common stock advanced decline line, we are breaking out and starting to come back to this previous high, seeing a little bit of a negative divergence based on volume. When we look at our advanced decline line studies, we saw advances pretty much across the board with all the different indexes. Looking at our trend, the ADX is above the moving average and moving higher. The green line is turned back up. It's kind of hard to see because they're right on top of each other. But this is turning back more positive. You could say, okay, that suggests good solid momentum on one hand, or we're getting close to this 40 level again, meaning that we might be getting extreme positive. We can say that same thing with the shorter term ADX. It's already above 40, above its moving average, and the green line is going back up. Volume dropped off just a little bit. A lot of apprehension ahead of what the Fed's going to do. Our short-term charts, we did come up to the underside of this trend line, back down a little bit. Now we're starting to break out above previous resistance. We might come back up and hit this trend line again. We'll have to see if it plays out that way. On the bottom, you can see where volume did drop to below average. We're still hanging in there okay with our double and triple exponential moving averages based on 20 periods. Those are showing short-term momentum. And we're coming down just a little bit with our 20-period exponential moving average, but we're still extreme, rolling over a bit with the 50 and tick down just a little bit. It's probably hard to see with the 200-day, and it's not extreme yet. Williams percent R continues to be extreme positive. The CCI 20 coming down, but still extreme positive. Our stochastic, short-term extreme, intermediate-term extreme, crossed below the moving average in the long term, but we're still extreme with all three of these different time frames. The force index is above 0 and advancing. That's positive. Our intermediate term charts were above the dashed line with the balance of power and ticked up slightly. We're doing okay when we look at the double and triple exponential moving averages based on 50 periods. We're still above the red line, which is the triple moving average. If we fall, we'll see if the double ends up providing support. It has done that in the past. The go-no-go system remains positive with the dark blue bars. We're getting back up to the higher level of our highest high reading now, but this is flattening out a little bit as things have been slowing down slightly. The TTM squeeze, this is slightly negative. We're turning darker blue now as this oscillator is starting to roll over slightly. We're still at the third level of our standard deviation, suggesting that we are overbought. The rate of change also above this line, suggesting an extreme positive reading. The Erin indicator ticked back up a little bit, showing the buyers came back in as sellers are decreasing. We did have a recent extreme positive reading on this indicator, but we could always go back higher if the market continues to go up. We came down a little bit with our S&P 500 McClellan oscillator, but we're still above zero. So based on price, we're coming back to this previous high now. We'll see if we are able to break through that. We're showing a little bit of a negative divergence with volume, but volume is also advancing. The NYSE McClellan oscillator did decline, but is still above zero. So our summation index based on price and volume continue to show improvement. We're actually seeing more strength based on volume, where it's a little bit of a divergence based on price. The Swenlin trading oscillator pretty much flat based on price and actually ticked down slightly based on volume. So we're seeing a contradiction of signals. The PMO continues to be positive, also based on price and volume. Our PMO study, we're dropping off a little bit with the percent of PMOs that are rising, flat to slightly declining with the buy signals, and still looking rather extreme with the PMOs that are above zero. Again, two ways, extreme positive or showing good momentum. The Elder Impulse system for the S&P still remains neutral. The parabolic SAR still remains positive. The slope is starting to roll over a little bit. That's a little bit of a concern. This is our touchiest oscillator, so we want to keep an eye on that. The MACD is not quite crossing over yet, but also rolling over a bit. When we look at all of our oscillators, we're looking a little more negative in the short term, a little bit of weakness in the intermediate term. We're still flat to slightly positive in the longer term. The Sean trend meter continues to be extreme positive. We're also extreme positive with the BPI. Two ways to look at it. Extreme or showing good momentum. NYSE bullish percent index advancing and looking more positive. Chaikin money flow did show some money coming back into the market, where the Chaikin oscillator continues to be negative. The money flow index above 50 and advancing, that's positive. Ultimate oscillator almost got down to 50 but is now turning back up. The vortex, the green line, is turning back up, so that is positive. We're not really concerned as much now with this negative divergence with the RSI because we're starting to get extreme positive, both based on the 14 period and the 9 period. We'll have to see how high these go if it generates a new negative divergence. On balance volume continues to be positive. We're still showing strength when we look at our 200-day simple moving average study of the S&P 500. We turned down just a little bit based on the 50 period moving average study. Here's that same chart showing it on a histogram. The Copic curve rolling over a bit but still generating a buy signal. And here's a new positive one. We're crossing over with the Pring bottom fisher. That's always positive when it generates something. It doesn't always mean that's really a buy signal. It would be nice if this reading had been lower and then starts to turn up. That means more of a washed out type of situation. But just the fact that it is crossing over positive is something to be aware of. I have one chart to show you. We're getting up closer to August 1st. This is how we've been performing for the most part for this last 50-day cycle. If we hit this August 1st point, is that going to produce some kind of a change in the market? Our different charts, the Heiken Ashi, still looking positive. The Kegi has now turned back up. That's positive. The Renko chart is positive, and the 3-line break is also positive. Our different indexes. Equal weight index underperformed slightly, but it's still showing an improvement compared to the S&P 500. So we ticked down just a little bit with our ratio, but earlier it was all the big stocks leading things. Now we're wondering, can the smaller stocks come in and start to produce some strength as well? Looking at Dow theory, we're still breaking out with the Dow. We turned down a bit with the transports, but they're still breaking out overall, so they're confirming each other. But we would really like to see the transports show some more strength. Utilities turned back up a little bit more after breaking out last week, and that can give some headwinds to the S&P 500. The transports to S&P 500 ratio did decline, but it's still advancing overall. We want to see this really going up. Looking at our discretionary versus staples equal weight study, where we were pretty much flat with discretionary. We turned down just slightly with staples, so we were flat overall, but still discretionary is outperforming staples. The Dow continues to just put in a series of new 52-week highs. The diamonds have switched to neutral even on an up day. The NASDAQ also showing a little bit of improvement. We have not been able to break back above this pivot level yet. And we're also watching the 61.8% retracement level for the NASDAQ. If we start to fall, will we hit that? or are we going to keep going up higher? We're still seeing overall weakness with the cumulative new highs, new lows in the NASDAQ, and we've been seeing that for a while. The indicator that we use where we subtract the new highs from the new lows, it did go slightly positive on Tuesday. We're still wondering about this whole situation. We're above the August 2022 highs. If we fall, will that provide support? We're starting to come back up to this pivot level. Can we turn and go back higher with the NASDAQ 100? We continue to be neutral with the Elder's Impulse system for the NASDAQ 100. This is another chart that we're keeping an eye on. We saw a longer-term negative divergence where the NASDAQ 100 was making a higher high. That was not confirmed by the PPO momentum oscillator, where now it's actually dropped below its moving average and starting to decline. That could be a little bit of a concern. Also, we're seeing the BPI for the NASDAQ 100 also roll over. It's not an official signal until it drops below this line, but to see the NASDAQ 100 trying to break out and move up a little bit higher while the BPI is actually declining, that could be a negative divergence. Small caps still above this support level and pretty much chopping sideways currently after generating a recent golden cross with the S&P small cap index. Here's the Russell 2000 small cap index. We have not been able to get above this resistance level yet. We are working off of a golden cross. We're pretty much going flat with the RSI, but we're above 50. The MACD is still positive, but starting to roll over. So these are just little signs of weakness that we're seeing creeping in across the market. We continue to be neutral with the small cap index based on the Elder's Impulse system. Small caps tick down just a little bit compared to the S&P, and they continue to underperform overall. When we compare small cap growth to value, we saw a little bit of a tick up. We're going sideways, but still in an uptrend. The mid caps are also maintaining current prices above this support level. But we still remain neutral with the Elder's Impulse system. When we compare mid-cap growth to mid-cap value, it ticked up slightly. It has been stronger after seeing some recent weakness. The dollar is still above 100 and continuing to go up slightly. We're still down below this all-time high for the FANG index. We came up, set a new all-time high, fell back down. We were up almost 1% on Tuesday, but can we keep going back up to try to retest that high, if not create a new one? When we look at the broad market, the S&P 1500 was shorter-term bonds. Stocks continue to outperform bonds. Another broad market measure looking further out, also stocks are outperforming bonds. The tech sector also outperforming bonds. Home construction, haven't shown that in a few days. It had a good day and is also really outperforming bonds. And this is a highly interest rate sensitive area. Would it be going up like this and outperforming bonds if this part of the market was concerned about interest rates? Bank Watch, we actually went down a little bit after the bank ETF had a few good days. The financial sector did decline, but we're getting close to what could be a golden cross. When we look at the financials compared to the S&P, they did underperform and they continue to be in a downtrend. When we look at the regional banking ETF compared to the financial sector, it is really underperforming. Keeping an eye on bonds, we were up based on yield and down based on price. We've dropped further below the 200-day moving average. We've dropped below 50 with the RSI. The MACD is still positive, but starting to roll over. We're also looking at the value to growth ratio. These have a tendency to have a pretty strong correlated relationship. The black line is the value to growth ratio itself, where the red line is the 10-year yield, where you can see when they're up at this high level, they're going in the same general direction. That's really dropping off, and they're having a tendency to go in opposite directions now, which could be a bit of a warning sign that we're going to see a shift in the market. But when you look at riskier bonds and compare them with more conservative bonds, this ratio is starting to turn back up. We're also concerned about this. When you look at cash and then 3 to 7 year bonds, we want to see this declining. It's not doing that. It's actually going back up. So there's some uncertainty about interest rates. Our long-term charts, the Special K daily chart continues to break further away from the red line. That's positive. Here's the weekly chart. We're still below the red line, but we are showing some improvement. If we see some weekly back-to-back gains, it could turn this indicator back positive. Here's where we're looking extreme with the 150 and the 200-day moving averages. And we're also dealing with this longer-term resistance on the weekly chart. We're above it for right now. Are we going to be able to stay above that level? Also, we're seeing the same thing with the NASDAQ 100. We're above this resistance level. Will we be able to stay above that? When we compare the NASDAQ 100 to the Dow ratio, also getting at a pretty high reading Other times when we were at this high of a reading in the ratio, there were some real problems for the market after that. An update of our possible positive scenarios. We are seeing some weakness here, and this is part of what I was alluding to. We're seeing the Qs really drop down compared to the S&P, the same with discretionary, and the same with large cap growth versus large cap value. And we're seeing it across the board here with our growth to value ratios with the large caps, mid caps, and small caps. A little bit of a concern, not a major concern. This can always repair itself. But in a good, solid environment, we want to see growth really outperforming value on all the different areas that we look at. The S&P to utilities ratio ticked down slightly, but is still going up overall. Looking at the broad range of the 5-period moving average of the highs minus the lows, we continue to be positive, suggesting good broad-based advancement. We're still at the high end of our 10-day moving average of the S&P 500 highs minus the lows. That's still suggesting good momentum. We've been camped out here for quite a while. The 50-period exponential moving average of the new highs minus the new lows, the moving average itself continues to advance. The indicator, which is the black line, continues to be above zero, which is helping the red line to go up. We saw a little bit of improvement with S&P growth to value. We are going down in the shorter term, but longer term, we're still in an uptrend. The Staples to S&P 500 ratio did spike up a little bit, but still we're seeing a pretty big decline, which has been giving good support to the S&P. So what's our outlook for Wednesday? There will be a meeting of the Fed. That's what everybody's all worried about. On Thursday, the European Central Bank, and then on Friday, it will be the Bank of Japan. There'll be lots of influential earnings reports that will be released. We'll have to see how the market reacts to those. The technicals are positive, but we're still overbought. And then the economic reports coming out, we'll get the weekly MBA mortgage index, we'll get new home sales, as well as the FOMC decision. That will be at 2 p.m. Eastern Time. And then at about 2:30 p.m. Eastern Time is when the press conference starts. We're still watching all the geopolitical events, but right now it's all about the Fed. Here's the updated economic calendar for the week. And then looking at the Stock Traders Almanac statistics, we're 50-50 for the week after options expiration. And we're neutral to positive across the board with the Dow, S&P, and NASDAQ. This is the day that the Fed will make their announcement where we're seeing a little bit of strength, neutral to positive. Then right after this is when we can often see some weakness going into the latter part of July. We're also keeping an eye on that for the NASDAQ. We're coming into that weaker part of July now. So our scenarios, not going with the down one because our technicals are positive. However, we are overbought. If we default to anything, it would be to the upside, but we are extreme positive, and there are some small areas of weakness that are starting to develop. We're definitely not going with the sideways trend right now because our ADX is strong and it's above its moving average. So our warning signs, we're still wondering, is there a convergence of these short-term bearish signals? We're kind of losing the effectiveness of this. Some of these are still in play, but some of them have kind of come and gone. The longer-term trend signals on those weekly charts, we might be at a top. It's going to take some time for that to work out. We're coming into a seasonally and historically weak time of the month. The oscillators are starting to look a little bit more negative on the ones that we look at. We're still noticing the NASDAQ 100 oscillator that's showing that negative divergence and turning more negative. The VIX is still showing that there's not a lot of fear. The cumulative new highs, new lows for the NASDAQ continue to show weakness. I haven't shown the chart now, but we're still above that 3-month yield going back to 2007, which we hit right before the great financial crisis happened. The S&P growth is weakening a little bit, but it's still positive overall. And then we're dealing with earnings season on a company-by-company basis. The positive signs, we do have in the background positive seasonality and setups. The long-term special K daily chart is positive. The weekly chart, it's still negative, but could be showing some improvement. The long-term equity put-call ratio is positive. We're still above the downtrend channel upper line, which I haven't been showing that chart. We're still in a risk-on posture, even though that is showing some weakness. Lower price levels may provide support. And if they don't really like what the Fed says or what they do, and we really start heading lower, we're going to possibly test some of these support levels. The S&P continues to outperform utilities overall. The NASDAQ and NASDAQ 100, they're still breaking out above that longer-term resistance, but they still have not been able to get back above that pivot resistance that we hit and then started coming back down from. The Staples to S&P 500 ratio is declining, Both the Russell and the small cap index, as well as the mid caps, have generated recent golden crosses. Small and mid cap growth continues to be positive. The Copic curve, as well as the Pring bottom fisher, have generated buy signals. So our conclusion, the S&P is positive, but it's still overbought. Not a lot has really changed with that, both in the short term and in the intermediate term, but we're still positive in the long term. So thank you. Have a wonderful day, and I will talk to you in the next video.